So as promised, let's get more corporate conversations going. Gulf Oil Lubricants is in focus. Now, there's been a large transaction in the global lubricant space. BP has sold off a 65% stake in Castrol to Stone Peak. And we want to understand whether that gives us any more clues about the lubricant market here in India. How should we read such a large global transaction? And, how Gulf Oil looks at the India opportunity. Ravi Chawla, MD and CEO of Gulf Oil Lubricants, is with us. Thank you for joining us, Ms. Chawla. Season's greetings. So, of course, 3 key talking points. I just want to run our viewers through that. Of course, we want to get your take on the global perspective, this large global deal and how we should understand it. Your own levers for growth, looking at the Indian market here. And, of course, the strategic roadmap ahead for Gulf Oil Lubricants. So, Mr. Chawla, let's start right there. What a big transaction. BP selling off Castrol, and obviously the Indian listed entity, there's a transaction that's underway, the open offer that got triggered. But how should we read it? I mean, is the lubricant market not as attractive for large global energy players? Is it becoming a more niche market? Just give us your view on the transaction and the read-through for investors here in India.
Yeah, so Happy New Year to you and the viewers. Well, of course, we all are hearing about the transaction. I think it just signals that it is a growth element in India. For sure, the lubricant market is the 3rd largest market, growing the fastest. And I think globally also the market has its attractiveness. As you know, the core ICE vehicles are intact and the EV is also coming in. So I think overall it's an opportunistic market for us, for India especially. So I think it's a good place to be in. And yeah, this transaction, obviously we have to wait and watch what happens. But we always look at the opportunities, and India is well poised with its economy and other things. So I think it augurs well. And of course, big corporates take decisions based on their own needs. So that's something which is obviously happening.
But Mr. Chawla, I mean, I understand this was a global transaction, so structured very differently. But does this mean that at some point, and Gulf Oil has exhibited really good growth in this year as well, I think 15% volume growth. So does it mean that your commitment to the India market remains absolutely rock steady? Would you look at more organic growth here? Would you look at inorganic growth, acquisition opportunities if they come up along the way?
Well, you have to, obviously you have to watch what's happening, and we look at competition in many dimensions. And we basically are focused on our market, and we continue to invest in it, both in terms of our distribution, brand partnerships. So I think we are very focused on that, and we are also a global player. So if there are opportunities, obviously one will look at. But, the good thing is that there is excellent consumption of lubricants, and more high-end lubricants also coming in. So I think both these augur well for in India and overseas for us.
And as of now, are you looking at any form of an inorganic growth opportunity through assets, brand, or distribution?
Well, we embarked on some investments in the EV space, as you're aware, in terms of chargers. And we would definitely look at some opportunities. We're looking at a lot of industrial lubricants coming in. So I guess opportunities are always available. We have the cash here. We also look at opportunities, around our current operations. So I think that's always on the cards. And we'll have to wait and watch. And as I said, we continue growing in our own strategies. And we have market shares which are still below 5% in some segments. So we see that both geographically and segment-wise to be a great opportunity in itself.
So on the EV subsidiary, you recently increased your stake to 65%. Would you be looking to further increase it?
Well, we are working very closely with the founders, and I think that's the strength of having them. They've been in the market for a few years and have a 10% market share. So we continue working with them, and the key founders are still owning the rest of the 35% odd. And, there is obviously adding value together. We're looking at that. So at the moment, yeah, this is what it is. And we want to continue, 1 out of 4 buses, we believe, has our chargers, so EV buses. So we want to really expand both into AC/DC chargers. And right now, yeah, we are looking at increasing capacities for our chargers also.
Got that. And tell me about the other white spaces that you would be looking to expand, get into, either on your own or via acquisitions.
Well, you see, in lubricants, we have all the products in automotive industrial. So we have a global R&D center here in India itself. So we have a lot of space there in terms of our market share, as I explained, in industrial lubricants, in areas like, the infrastructure segment. Even in our B2C bazaar market, we have geographically a lot of opportunities. So we'll continue looking at these opportunities. A lot of the markets like the passenger car and motor oils, we have less than 5% market share. In basically diesel engine oil and motorcycle, we are close to double digit. But for us, it's an all-round opportunity. And as we've been growing 2 to 3x the market, we're also seeing the market is growing well. Rural is growing now. Penetration of vehicles is going up as India goes into obviously more affordability. Rural sector is again doing well. So I think for us, it's also looking at our own expansion. Our brand is in the top 2, 3. So we want to increase our distribution. We've got excellent OEM partnerships. So I think all around for us, it's more working harder and working smarter in the market.
This INR depreciation impacted you all in Q2, but there has been a further depreciation even in Q3. What should we expect on margins? And is there a risk to 14% margins for the full year because of INR depreciation?
Yeah, so you're right. While crude is soft and steady, that is good for us. The INR depreciation has been close to 6% last 9 months. And I think that has really created some pressure. So we do have price increases of minor price increases we are taking. And I think for us, the 12 to 14% band is what we want to protect. Ideally, we'd like to move up. So hopefully we can see the exchange rate coming a bit steady. And then, next year we can work on that. But I think for us, the band 12 to 14 is what we've indicated. And we are also trying to launch a lot of premium products. Recently launched a full motorcycle range called Syntrack. We're also looking at segments where we can add more value with our products. So I think it's a journey. And as we've indicated, yes, this exchange rate has been a challenge in the last 9 months.
I think you import about 70 to 80% of your base oil. So the exchange, the forex depreciation of 6% does hurt. But you're confident about maintaining margins of 12 to 14%, at least for FY26. But the goal thereafter is to further increase the margins with some premium offering. So say 3 years down the line, what is the margin that you're targeting, the margin range?
Well, it's a very competitive field, and we have the different segments which we obviously want to gain market share. So as I mentioned, definitely we want to move up to the 14 to 16. We are going to be watching obviously what happens in the market, and with our positioning, we are quite confident that we can improve the margins.
And by when do you think, Ravi, you can get to 14 to 16% margins?
Yeah, we are trying. I think this time the exchange rate obviously had an impact. So some of the controllables are with us, some are not. But we are pretty confident that with our products, etc., we would be able to take it in the much higher than what it is today.
Got it. And how much of the impact because of rupee depreciation have you been able to pass on via price hikes? Because as you said, it's a competitive market.
Yeah, so we have price variation clause with our OEMs. We have a large base of more than 40 OEMs, so that happens in the next quarter. And then we have also taken some price increases in the B2C, some of the segments. So I think it's getting passed on, but obviously we would like to have that go on in a faster way, and hopefully the exchange rate will stabilize, and that will help us to improve our margins, because the new products will take time to get accepted and obviously distributed. So that takes a couple of quarters.
So price hikes are fully passed on, or they will be by Q4 end?
Yeah, so we've been kind of looking at the competitive scenario. So part of it has gone through. Some of the products, obviously there is competition. So I think there would be a partial sort of rollout of it. And for the bigger customers, we would see the next quarter where the PVCs come in.
And what's the extent of the price hike on a blended basis?
So it's a couple of rupees, not a major one, but it's kind of trying to stabilize on the exchange rate impact.
You were just telling us about how the core business itself is seeing very strong innate demand. The rural market is picking up, B2C, etc. Now, you've spoken about high single digit to low double digit volume growth for the core lubricant market in FY26. Is that on track, or do you think you can do better? What is the volume growth that you foresee for FY26?
Yeah, so we have done about 10% growth in volumes, core volumes of lubricants. I think Q2 was about 9.5. So I would say that it would be around this percentage. Of course, we are seeing that we had a good agri season that came in this quarter that may not be there in the fourth quarter. So I think market will grow about 3.5, 4%. We would do at least 2x that in the coming quarter. And that's been our sort of push in terms of our segments. And we're also seeing the OEM piece do very well. So I think if market grows 3.5%, we should at least do about 8-9% growth. Hopefully try to always do better. But I think that's where probably the outlook would be looked at this stage.
Thank you, Ravi, for joining in. Wish you, your family, and the entire team at Gulf Oil Lubricants a very happy New Year. Well, Well, that's the word coming in from the company. Very confident and committed to the India business. Margins will be maintained between 12 to 14% for this year, despite the INR depreciation. But the company is hopeful of expanding the margin range and increasing it to 14 to 16%. For the full year, the company is looking at volumes of 8, 9, 10% kind of, nearly 2x of that of the industry, which is likely to grow 3 to 4%. Get in